Howdy, ladies and gentlemen. My name is Lars Schall. I am an independent financial journalist from Germany, and on behalf of Matterhorn Asset Management in Zurich, I am now connected in Singapore with fund manager Grant Williams. Hi, Grant. How are you?
Hey, Lars. I'm great. How you doing?
Great. Thank you for being with us. Let us start a bit philosophical and kick off our interview with a question raised by the German poet Heinrich Heine, who's my favorite German of all time, by the way. Heine was asking himself, does the religion of today consist in the monetization of the needy or the deification of money? What do you think, Grant? Is it probably both?
Well, you know what? I've got to say, that's the first time I've been asked a question on philosophy when talking about gold, which, I guess it's kind of interesting because, if you think about what gold is, philosophy is a belief. And gold essentially is a belief, right? I mean, let's face it, it's something someone pulled out of the ground, and over time it's had a value assigned to it, and that value is essentially down to belief. So it's interesting that philosophy doesn't come up more when you talk about it. Whenever I talk to people about it, I stress the point that because you can't value gold like you can value most assets on cash flow or look at a balance sheet or an income statement, it really is something that you value emotionally or in your belief in what it can do for you at certain points in the cycle. So look, I mean, I think it's a little bit of both. I think money is essentially a means to an end. Money gives you the ability to acquire assets, any assets, whether those assets are long term like a house or a business, or short term like food. Food is temporarily an asset, whereas wealth is a measure of the value of those assets that you own. Money is essentially just a medium of exchange. So I think people do deify money because that's just the way society conditions you. Paul Singer wrote a letter recently, and there was a great quote in that which I requoted recently. He said money has no meaning beyond the value of the real things for which it can be exchanged. And I think that's very, very true. It's true of gold as a unit of exchange, which has held its value far better than money as we understand it over the centuries.
Let us take the philosophical path a little bit further, because in 1900 the German philosopher Georg Simmel gave an interesting answer to Heine's question. He pointed out in his book The Philosophy of Money that money occupies in modern societies a function of a god, respectively replaces it. Money is turned increasingly from a means of exchange into the absolute end in itself, a thing that is universally and perfectly usable and provides enhanced potency. In short, the self-esteem of man depends on money. Do you think, Grant, that money has become too important?
I think I touched on this in the previous answer, and again, Lars, it's very interesting because if you think about the kind of society that the West certainly has developed into, we live in an inflationary society. We live in a world not just now where central banks, governments are trying to generate inflation, and inflation in the modern world is a quasi-permanent state. We do have these bouts of deflation, but the cure for it is always inflation. So whenever you have this question and this debate over inflation or deflation, the answer is always inflation. The question is when do we get it again? And we will get it again. So I think in an inflationary environment which we all live in, money becomes more important by definition, or almost accidentally, because you tend to have to earn more of it to be able to survive. And we've seen that never more clearly demonstrated in the last several years, where we are seeing prices going up and wages remaining stagnant at best. And so money becomes important because of the policies of inflation. So there are plenty of gods that get worshipped in today's society. The iPhone has become a god, the iPad has become a god. The Kardashians, God forbid us, have become gods. But overall, I think money, the importance of money, is increased with every round of QE and every expansion in the prices of goods and services. and every moment that wages stay stagnant.
Yeah. Would you also say that in certain circles the free market is also a god?
Yeah, but look, unfortunately, I think the free market, if you think about a purely capitalist system, the free market should be the ultimate god. And unfortunately, we've had. I wrote a piece a while ago called Deus Ex Machina, the god outside the machine, and that's essentially what central banks have become as they've tried to limit the damage and constrain the business cycle. They have actually corrupted those price signals and that perfection of a capitalist system. So, in an ordinarily functioning capitalist market, I would say absolutely the free market is the deity above all deities. But I don't think we have that anymore. I don't think we have free markets anywhere.
Mm-hmm. Well, the final philosophical question for this interview: is finance about power, and if so, toward what ends?
Well, I think money and power, finance and power, have always gone together. Always. I mean, that's gone back as far as you want to go. They have a circular relationship, really. I mean, money can buy you power, and if you find a way of getting yourself any real power, it's been proven to be a very good way to get rich. So I think they have a very circular relationship. But I think there's a third part of that equation, and that's corruption. I think wherever you find money and power, you find corruption, because they're both intoxicating things, both money and power, and people will do things outside the bounds of acceptable behaviour to achieve either end. So, you and I immerse ourselves in the gold markets a lot, and I always find it extraordinary when you think that gold is essentially money. Gold is the purest form of money there is. And yet people find it impossible to believe that there could be any manipulation of the gold markets. Now, if gold is as pure a form of money as you can find, and corruption and money go hand in hand, which they have since time began, to me, the extent of the manipulation and the corruption in the gold market is the only thing that's debatable, not the fact that it is there. So, in answer to your question, I think it's a very circular relationship, but I think there are 3 points in the circle that revolve around each other.
And since we talk about money and power and gold, hasn't Mr. Exeter called gold once power money?
Yeah, I mean, look, that pyramid is something that I think you can show anybody and they will understand it. And at the bottom of all this stuff is a very small amount of gold. And over the centuries, it's become money. Whether you take the Buffett view and think it's just a shiny yellow rock that you dig up and pay someone to bury for you again, it's just a moot point. I mean, the argument's not worth having, because enough people ascribe a value to gold that it's real. I mean, the value is real. I mean, no one's going to unilaterally declare that gold is not worth anything anymore and give their gold up. So, I think those sort of arguments are spurious. We have an element here that has, through thousands of years of history, been ascribed a value to it, and its value is real today.
And one thing that I like to point out when it comes to the question whether gold is money is that private banks are trading gold on their foreign currency desk, right?
Yes, absolutely. Yeah, absolutely right. It's a great point, and it is a currency. Look, let's face it. And of all the people to confirm this for us in the last week, to hear Alan Greenspan say that was somewhat ironic, but he was very, very clear. I mean, he's a former Fed governor, former disciple of Ayn Rand, seemingly rediscovering religion again, and saying categorically that gold is not only a currency, but it's better than any fiat currency in history. And I think he's absolutely right.
Yeah. Would you say gold is the kryptonite to the US dollar?
I think it. Kryptonite is probably the wrong analogy. I think it's the truth serum to the US dollar. I think ultimately, right now the dollar is kryptonite to the gold price. We're seeing this strengthening dollar that looks like it could have further to run. And so, for an asset that generally is quoted in dollars, the price action looks pretty ugly in gold right now. Although, obviously, if you look at it in yen, it doesn't look anything near as bad. So I think gold and the dollar have a relationship where only one can ever be in the ascendancy at the same time. But I think I would describe gold as the truth serum to the dollar. And while the dollar may have the upper hand at certain points, ultimately the dollar is not money. The dollar is means of exchange. It's a piece of paper. It's a promise to pay someone. And at some point, it's already lost 90% of its value since the gold link was removed in August of 1971. And I think that pays testament over time to which one of these assets you would like to own in the long run. It's curious to me that we get discussions a lot over the last few years about possible return to the gold standard, and people talk about that as if it is an absolute impossibility. And I think a lot of that comes from the fact that we haven't had a gold standard for 43 years, which is an adult lifetime for most people. Certainly, they're sort of the point in their life where they're going to be engaged and invested. And just because we haven't had one for 43 years, people forget that in the last 200 years we've been on a gold standard more than we've been off one. So it's not that big a stretch to find ourselves at some point, and whether it's the dollar or whether it's an Asian currency that reintroduces some form of gold standard, some form of hard backing for currency, I don't know. But I think it's inevitable at some point.
Well, since we are talking about money, what are your thoughts on the fact that people begin to pay much more attention to the process, how money is actually created? And do you perceive our system of private bank-created money as an issue of major importance yourself?
I think the debate is important. I think people understanding the process by which money is created is incredibly important. But I think it's something that is difficult for people to understand unless they're really engaged and they really want to understand it. I don't think it's something you could explain to someone who doesn't understand it in a short space of time. So I think the debates that have been raised by QE around the nature of fractional reserve banking and the creation of credit. The creation of credit is not an evil thing. It's been instrumental in the development of society, but I think the important point in this cycle was when we broke with gold in 1971. I keep going back to that. And if you look at a chart of total credit outstanding in the US versus GDP growth since going back to the 1920s, the two of them moved in lockstep until 1971, and then they started diverging, and credit started outstripping GDP growth enormously. And then once we got to peak interest rates in 1980, and they started falling, which as we've known now is a 34-plus year process, you really saw credit take off. And it's that massive expansion in credit which central banks have gone out of their way to ensure can continue, because credit feels like prosperity at the end of the day. What we saw in 2008, if you look at it on the chart of credit expansion, you'll see it was a tiny, tiny blip. And the lines on that chart of GDP and credit growth are still way too far apart, and for them to come back into line would be devastating for the world. So credit as an idea is absolutely not an evil thing, but it's been used to simulate growth over a 40-year period, and the imbalance now has got to the point where anything must be done to avoid the true process of price discovery. And I think that's the danger. So people understanding fractional reserve banking is the first part of the debate, but I think understanding the danger of having a credit cycle where the central banks try and negate the process of creative destruction that Schumpeter identified is a very, very dangerous thing. But unfortunately, that's the sort of feedback loop that we're stuck in right now.
Yeah, and isn't also there the possibility? Well, you know, there are lots of advocates for the Chicago plan, this 100% money, and isn't it maybe the possibility to introduce then the gold standard if one would take all the money creation power away from the private banks, give it to state-owned banks or a state-owned central bank, and then to put some brakes on the money creation process that there will be no hyperinflation, that some people would use this to introduce then or reintroduce then the gold standard?
Well, as I said, I think at some point a return to some form of gold standard will ultimately be forced upon the world. I don't really think there's any alternative at this point. You cannot, trees don't grow to the sky, as everybody says. You cannot keep creating money out of thin air. Personally, I like any decisions to be in the hands of the private sector rather than the state, even when it comes to money, but only on the basis that we reinstitute the bottom half of the business cycle. If you have private banks that can go bust and in which the directors bear responsibility, we can go back to sound banking. And I think if you can somehow engineer a return to a far more sound banking system, then I wouldn't for a second advocate that you give the power to the government and the state to regulate things. I'd much rather it was done by the free markets. But again, we get back to that problem we had before. Do we have free markets? No. And I see governments and central banks grasping for more control over markets, because I think the free market tendency right now would be to trade a lot lower than now, whether it be equities or bonds. I think the free market wants to trade lower, but it's just not being allowed to do so by the frantic injection of money into the process by central banks.
Yeah. Related to the money creation process, I ran across the following theory, namely that the level of economic activity depends on the lending decisions of banks and the repayment decisions of borrowers. If banks lend more rapidly or if borrowers repay more slowly, there will be a boom. If the reverse is the case, there will be a slump. What are your thoughts on this? Does this sound sound?
Well, it's a very simplistic analysis, and there's some truth to it for sure. But as much as I would ordinarily agree with a lot of that, I think it's impossible not to stress enough the damage that's been done to all these processes, all these theories, by the insertion of central banks into the process, and as I said, the corruption. And I mean, when I use the word corruption, I mean it in the true sense of the word. It just means that the normal channels, the normal signals aren't flowing as they would ordinarily do. And to have these outside agencies which have up to a point unlimited power. Their power is only limited by the confidence that the markets and the public have in them. But by introducing that kind of player into a game that ebbs and flows in a way that never really gets out of control, by doing that, you essentially make it impossible to really understand what the true mechanisms and the true channels are actually doing. And I think this is arguably the most dangerous thing right now, that the central banks have become such an enormous part of the game that they can't really remove themselves from the process. Now, we've seen the Fed end their taper this month, and a lot of people said they wouldn't be able to do that without some upheaval in the stock market. Well, we did have some upheaval in the stock market a few weeks ago. The markets fell 10% in a few days. And they've stabilized, but the reason they've stabilized was because the Japanese, the Bank of Japan, picked up the baton where the Fed had ended and did something that, I think when history looks back on this this last 5 years and the next 5 years, the move by the Bank of Japan on Halloween is going to be seen as a tipping point of sorts. The markets are rallying because of a promise of new money being injected by the Japanese central bank. Ordinarily, that wouldn't have such a strong effect overseas, but the mechanics of it and the simultaneous announcement of the Japanese pension fund, which is the largest pension fund in the world, is going to aggressively buy foreign equities, is enough. It's enough to keep these markets going higher, and that's fine as long as it lasts. But as I was saying to someone recently, if you want to buy some shares, I can always find some stock for you to buy. Always, there will always be shares you can buy, bonds you can buy, real estate. It's just a question of price. So these markets go up and they go up and they go up, and it seems extraordinary to anyone looking at them with any kind of common sense outlook. Now, I'm not saying the people who are just closing their eyes and playing the trend are fools. Far from it. They've been making good money. But the point is, when this thing turns, while you can always find something to sell someone, finding a buyer is a completely different ballgame. And so I think we're going to see when these markets turn, we're going to see central banks be forced to step in to support these markets again. And at some point, as I said, the central bank all the central banks are restricted only by the amount of confidence that the public have in them. And if they're forced to step in again to prop the markets up, that confidence is going to get chipped away. And confidence erodes very slowly and almost imperceptibly until the day it vanishes altogether. And it's the strangest things that lead to a complete loss of confidence. But once that confidence is gone, there is no way back for these guys. So I think it's a very dangerous point here to be very long of equities and very long of bonds when the only buyers are the central banks.
Mm-hmm. Is gold the hardest market to analyze because you have to take a lot more into account than just gold in order to do it properly?
Well, I think it's the hardest market to analyze because of what we spoke about earlier. It's something you have to value a lot of time on intangibles. But also, I think the extreme disparity between the physical gold market and the paper gold market is something that makes it very difficult to assess because it doesn't function the normal way. And what we've seen in recent times has been the perfect example of that. We've seen a slew of data points and announcements that ordinarily would make the gold price go significantly higher. If you took out leverage and you just had a stock of physical gold in the world, and we saw the announcements coming out of the Bank of Japan and the Fed and the Bank of England and various governments, if there was just physical gold in the world to own, and no derivatives, no futures contracts, no options, no ETFs, the gold price would be significantly higher. But because we do have this paper market over the top, where gold, and I use inverted commas around gold, can be created out of thin air and used to satisfy demand, it's really difficult to analyze gold, to make an investment case for it, and to act accordingly, because there are so many outside forces that can make the performance poor when the thesis behind owning it is strong. And that's exactly where we are at the moment. The thesis for owning gold is quite literally getting better every day. Now, if you're a technician, you can look at the charts, and now we've broken this triple bottom at 1180. You can make a case for it to go down to 1,000. That's doable, and there are plenty of people that will trade it that way. There's a lot of hot money in gold, and it's all on the short side now. And Bill Fleckenstein, I was talking to him a couple of weeks ago, and he made a great point. He said, back in 2008, when we saw this big event in the market and gold took a pounding, he said, I don't think that will happen again. If we do get a 2008 type event, I don't think gold will get pounded, because back then all the hot money was on the long side. We had Bear Stearns go under in March, and a lot of people had piled into gold, a lot of hot money thinking it was going to go higher. So when we had that big move down in September 15th, the fast money got out of gold. And Bill's point, I think, is a very smart one. He says, the hot money is short gold. if we get an event, you're going to see a big short squeeze go on that's going to push the price higher. And that's the problem with this paper physical disparity. I think you're analysing a physical commodity, but the price is being driven by a piece of paper, and that's a very hard thing to analyse.
I think it is safe to say that the Federal Reserve fuels with its ultra-low interest rates asset bubbles. But I think one essential question is very seldomly asked, and this would be this question. Could it do so, the Federal Reserve, if the gold price was much stronger?
Well, look, don't underestimate the power of the central bank to do anything to get prices up. Gold is such a small market that if we'd seen the gold price continue as it was doing through August of 2011, and let's say the gold price was standing at 3,500 now, I don't think that would stop the central banks in their furious determination to try and stimulate. Well, they would tell you stimulate the economy. What they're trying to do is stimulate the money flow. And so I don't think a gold price would be an impediment to that. I think the trouble with a higher gold price is it would mean that they would have to just step on the gas that much harder to try and generate that incremental movement in the measurements that they were targeting. So no, I don't think the high gold price would stop them blowing up asset bubbles, but I think it would make it harder for them and just make them more determined, which is even more dangerous.
Yeah, but don't you think there is a correlation between interest rates and the gold price?
Yeah, no, I think that there always has been, and you can look at benchmarks. You can look at real interest rates versus gold, and the correlation is pretty good. But right now, things. It's strange in that everything has a correlation of 1, and yet historical correlations have gone out the window. Stocks are going up, bonds are going up, real estate's going up. Everything has this correlation of 1. But if you look at the price of the S&P overlaid on the global commodities chart, and it's broken. Look at bonds and stocks, it's broken. Look at gold and the Federal Reserve balance sheet, it's horribly broken. So we're seeing all these divergences that over time will resolve themselves. They will, and I don't see the disparity between, for example, the Fed's massively increased balance sheet and a dramatically falling gold price. I don't see that resolving itself in a massive decline of the Fed balance sheet. It just can't happen. So I think all these links are there. But right now, many of them are broken, and until they all reset, and they'll reset once we take this outside agency out of the game, and that's the central banks, and that, as I said, only happens with a loss of confidence. You're really having to trade and position yourself and invest on a very long-term theory about what you think the ultimate outcome of this is, and the big problem to doing that is, as I say, because of this interference from central banks and the corruption of the price signals, then you need to be able to stay in the game far longer than you ordinarily would. People were seeing the NASDAQ bubble 6 months before it finally burst, and the NASDAQ almost doubled in those last 6 months. People were seeing trouble in the subprime market in 2007, and it didn't blow up for another 9 months. But eventually they did, and that's the big question mark: is what's the time lag between the smart people at the leading edge of these thoughts, these positionings, and the crowd catching up with them? And because of the central bank interference and the central bank intervention, that time lag has been stretched out already to a couple of years and could go on longer. But ultimately, it's doomed to failure unless they can generate organic growth and keep the wheels turning until that takes over. And I just don't see any way they can do that, I'm afraid.
Yeah. Will we see per se a flight into tangible assets?
Well, I think we're seeing it. There was the Paul Singer letter I referred to earlier on brought up a point that I've debated many times, and that's this supposed lack of inflation. The CPI is benign, as everybody tells us, and the Fed are telling us below their 2% target, which is great. So we can keep printing money. But of course, the way they've printed money and the ultimate destination of those funds has been into asset prices. So the rich have got richer, and the poor have got poorer, and the middle class are being eviscerated. So the inflation that you're seeing, and the inflation is where the money's gone, and the money's gone to the wealthy. So in his letter, Paul Singer explained that if you want to look for inflation, look at property prices in the Hamptons, and look at fine art, and look at rare wines. And while these are not the sort of things that everybody buys, and it's easy to kind of laugh at them and say, oh, we've got these poor billionaires. These are the guys with money, and they're trying to put it somewhere where they see prices are going to rise, and that's where the money is. So you're going to buy your house in the Hamptons for $10 million because you think, well, there's a lot of Russian and Chinese oligarchs there with a lot of dollars they want to get rid of. They're going to come for these properties. So it would be far easier if we had 5% rates and people could put their money in the bank and earn some interest like we used to be able to do. But that has been very deliberately stripped out of the equation to force people to invest their money in assets. So of course you're going to see these bubbles get blown, but they're going to get blown in the places where the money's got to.
What are your thoughts on the gold purchases by the central banks of China and Russia?
Well, I think they're incredibly important. I think they're misunderstood. I think they're not paid enough attention to. Our friend Kuz Jensen does phenomenal work in following these things, but he's only been doing that for a couple of years.
Yeah.
And there's enough opacity around the Chinese, for example, who in 2009 said that they had 1,054 tons. They haven't said anything since, but we see several thousand tons a year going into China, and not an ounce of the largest producer in the world being exported. So anybody that actually sits down for 5 minutes and thinks about it knows that the Chinese holdings are much higher than that. But because they haven't announced it, it's not something that people feel the need to deal with. The Russians are the opposite. The Russians announce their gold purchases every month, and they've been buying gold steadily. And recently picking up the pace. So their purchases in September were the biggest for 15 years. And a guy called Nick Laird down in Australia, who has a website called sharelinks.com, SHARELYNX, does tremendous work in putting together a chart database that follows all these statistics. But the gold market is a small market, and so people don't follow it. I live in Singapore, and you get a very different perspective living in Asia of what gold means to people. Here, I've said this so many times, gold is part of the DNA. People understand it, they want to own it. It's insurance, it's something that they buy in times of trouble, it's something they buy when they've got money. In the West, that's not the case. It's not really something that's important to people. So I don't think people are watching these central bank purchases closely enough. I think the people that are watching them have a very, very different picture of what's happening in the gold markets to the people who aren't. And what is happening is physical gold is just pouring out of Western vaults and into safe hands in the East. If you go back to the last really big bull market in gold in the late 70s into 1980, you had this spike in the gold price to at the time, $800. But there was no buying from Asia then. Asia was a very poor part of the world, but they didn't have any money. As Asian reserves have increased over the last 25, 30 years, their reserves are being put into gold. So if we get that event, if we get that sudden need to buy physical gold, not paper, not to hedge yourself by buying a futures contract, but to buy and own physical gold, it's currently being hoovered up by people who are not sellers $100 higher than this. They're not sellers $200. Many of them aren't sellers $1,000. To them, gold is safety until the siren goes to say it's all clear. And whatever the price, they're not going to sell it. So people should be paying attention to what the central banks are doing. They're divesting themselves of fiat currency reserve, particularly the dollar. They're buying gold hand over fist, and they're being allowed to do so. I'm sure the Russian central bank governments can't believe their luck that they're able to buy several tons of gold every month. I'm sure they're just high-fiving each other every day.
And do you think the Russians and the Chinese, or the people who are calling the shots there, they have analyzed the gold market, came to the conclusion that it's heavily rigged and that you can buy gold on discount and that you can actually use it as some kind of jiu-jitsu where you use the energy of your opponent to direct it against him?
Yeah, look, I think there is definitely a long game at play here. I really do. And I think anybody that is willing to entertain the idea that there could be manipulation of the gold markets. As I said before, it's my thing that confounds me the most, that people assume there wouldn't be manipulation around the purest form of money. But let's say you can persuade someone to suspend their belief that there absolutely couldn't be any manipulation of the gold market. Let's say that you allow that it's a possibility. As soon as you entertain that possibility and you look at the difference between what's happening in the physical market and what's happening in the paper market, and you look at the structure of the ETFs, and you look at how the ETFs work and what you would have to do to take delivery of physical gold in the ETF. You look at reports like Alistair McLeod's recently, which said that since 1983, China have bought over 25,000 tons of gold. Now, all these things sound far-fetched. They really do, and people dismiss them readily. And of course, I'm not saying they're all 100% accurate, but I think the mistake people make is they take some of these ideas. They take the idea of manipulating the gold market, they throw it out the window. They take the possibility that the Chinese, for example, could have had a 25-year plan in place to do this, and they throw that out the window. And I think they're very dangerous assumptions to make, because we've seen the physical metal being shipped. Again, Kuz has done phenomenal work. I did a presentation earlier this year about this, and likening what's going on now to the plot of the James Bond movie Goldfinger, where the gold was being smuggled from the west to the east because the price was fixed in the west, and it went to the free market in the east where people would bid it up. And I think that's happening. I think the evidence is substantial, but because it hasn't been recognised by official bodies, and the Chinese, for example, haven't come out and officially said, okay, we own 5,000 tonnes or 7,000 tonnes or whatever the number is, there's just enough plausible deniability that people don't have to deal with it. And I think in time that's going to be seen to be a very, very dangerous mistake to make, because when you need gold, you better already own it, because you're not going to be able to buy it.
As mentioned, you're based in Singapore. How important will the gold exchange there become going forward? I mean, as far as I understand it, it's a physical gold exchange.
Yeah, we don't know. I think it's too early to say, Lars. It has the potential because it is based in Asia. It's in a very strong financial centre where there are a lot of people from all over the world buying and storing physical gold. It has the potential to be not only very disruptive, but to be a major point where physical gold is taken out of the market and put into safe hands. I think it's a little too early to say. I think a lot of people feel as though ultimately they'll be safer owning gold in Singapore than they will Hong Kong, simply because Hong Kong is part of China, and I think people are a little bit nervous about what the Chinese could do if push came to shove. So I think Singapore is a better jurisdiction for people, but it's unproven as yet. And whenever you talk about gold, and whenever people are looking to store gold, they want security and they want to feel as though it's safe. And I don't think Singapore's exchange has a track record to really give people that amount of comfort just yet. But I think it will come, and when it does, then I certainly think it's gonna help, as I said, take physical gold out of the market and put it into safe hands.
Will gold become the ultimate bubble in the future after the bubbles in bonds and equities will have popped?
Well, it's a great question. I mean, talking of gold as a bubble, I always find a little off been, because, as I say, gold's a currency, as we discussed at the top of this discussion. And I think when the time comes for gold to do whatever it's going to do and go wherever its price is going to go, it's not necessarily because people are chasing gold into a bubble. The vast majority of that is going to be people trying to dump currencies. They're going to try and get rid of their fiat currencies as fast as they can and buy assets. And gold won't go up on its own. I think you'll see physical assets, commodities, real estate. I think you'll see another bubble in those at the same time as gold. But gold, to me, potentially has that added kicker of being something that you can't create it at will when you need it. And I really think this phenomenon we've seen in the last couple of years of the gold being soaked up by really, really strong hands who are not about to let it go if the price does get to 3,000 even. You're going to see the traders, and you're going to see the guys that buy the ETF, and they wanted to see the GLD price go up to reflect a $3,000 gold price. But I think if we get to the end game in gold, we get to the bubble stage, then the paper gold trading vehicles are going to be discredited, and you're going to see a big price difference between the ETF, where there will be doubt as to whether the gold is where it's supposed to be and whether it can be delivered, and a physical bar of metal. I talk often about the difference between the gold price and the price of gold, and I think it's important to understand that. The gold price is the price of a futures contract trading on the COMEX. If someone says to you, hey, what's the gold price done? And you hear it's down $20. Well, that's not the gold price. That's not the price of gold. That's the gold price. That's a futures contract. The price of gold is what you have to pay to put a physical ounce of gold in your hand. And at very few points in time will that be the same as the price of a futures contract. So, I think gold will be a bubble, but it won't be. It'll be a bubble of desperation and the inverse bubble of a complete loss in confidence in fiat currencies.
Yeah. How could one detect a bubble in gold? Are there some measures you would put to use?
Well, look, for me, I think first and foremost, I agree with my friend Simon Mikhailovich in New York, who has a great perspective on gold, and he and I agree that it's insurance policy first and foremost. Yes, people use it as an inflation hedge. Yes, they use it as a deflation hedge. But first and foremost, it's insurance. And for me, to see signs of a bubble in gold, I try to think of it this way: if I went and bought 10 kilos of gold tomorrow, and I stuck them away in a vault, and the price of gold started going crazy, for me, I'd want to keep some as insurance. But if I got to the point where those 10 kilos of gold could buy me, a harbourfront property in Sydney, for example, that I could exchange that gold for something that had more present value to me and was something that I would never have been able to exchange that gold for previously, that to me tells me that we are reaching some kind of top. If people are willing to exchange something that a few short years ago would have been valued multiples of what that gold can get me, I think things like that are signs of a top. I think when you start to see the dislocation that I suspect we're going to see in the paper and gold markets, I think they're going to run for a while before you really start to get that bubble. And of course, there's the age-old sign of a bubble when every member of the public that and you speak to that didn't know anything about gold in the last 5 years is trying to tell you how they've just bought this gold or that gold or this gold ETF or that gold product. That will be a guaranteed sign that we're near the end of the run.
I would like to talk with you now about the Swiss Gold Initiative. And I would like you to address some talking points that were put forward by the Swiss Federal Council, the finance minister, and the Swiss national banks as opponents of this referendum that's going to take place on November 13th. And the first thing was that I read about gold is too volatile and makes it a risky asset.
Well, look, again, we come back to this. We come back to this this age-old bone of contention. Now, if you look at what an ounce of gold will buy you over time, back in Roman times, an ounce of gold you could exchange for someone making you a toga, and at pretty much every point where you care to pick, you can essentially change an ounce of gold for a tailored suit. In London you can go to Savile Row with the equivalent of an ounce of gold and get a suit made. Same in New York. I think to say that gold is a volatile asset is, to me, it's laughable. I mean, it really is. I think it's arguably one of the most stable assets, but it is a very, very difficult thing for central banks to be shackled to, because it keeps them honest and it stops them. It stops them doing what central banks like to do, creating money out of thin air. It stops governments making promises to pay, which they'll leave to future generations to pay off. It is something that central banks really don't like being shackled to. But I think to call it a volatile asset, I think over the long term, currencies, fiat currencies, essentially go to their intrinsic value, which is zero. Gold has its intrinsic value, and it tends to hold on to it. So in the short term, in a week like we've seen the last week, can gold be volatile? Yeah, of course it can. Of course it can. But if you think about it, what that means is in the last week, the dollar's been volatile. So I think this whole discussion around volatility is somewhat futile as far as gold's concerned, because over time, it's the only asset that's proven to maintain its purchasing power.
Okay, another point is that says a yes means restricting constitutional independence and interference with monetary decisions by the Swiss National Bank.
Yeah, look, I mean, this it's all I can do not to actually just laugh out loud at that one, Lars, because let's imagine a world. Let's imagine the Swiss National Bank. I mean, go back to 1997, 99, I think it was, late 90s, when 43% of Swiss reserves were in gold. Go back to 2005, I think, when 18% of Swiss reserves were in gold. It was never a problem. Now they've gone down to 7%, but why have they gone to 7%? They've gone to 7% because they've been printing unlimited amounts of Swiss francs to defend the peg against the euro. Now, if you want to expand one side of this particular equation in an unlimited way and then blame the other side for restricting you from doing that, it's such a fallacious argument. I find it hard to take seriously. The big problem, I think, that the central bank of Swiss National Bank has, and the reason that Thomas Jordan is so concerned about this passing, and look, I think there's a very real chance it could pass. And just to go through the mechanics of it, if it does pass on November the 30th, the yes vote is enshrined in the Constitution that day. And so what that means is the Swiss government has to buy 1,700 tons of gold in order to get their current reserves up to 20%. Now, they have a period of time to do that. I think it's 5 years, which is fine, but they have to buy that gold, period. They also have to repatriate their gold from overseas. It's held in Canada and it's held in the UK. I'm pretty sure that's where it's all held. They have to repatriate that gold immediately. There's a process, it takes time, but they have to request it back immediately. Now, there are several ways this plays out. First of all, 1,700 tons, a buyer of 1,700 tons coming into the market, even over a period of time, puts a floor under the price. It also tells traders that, the wind is at your back now on the long side, which could spark a short selling rally. Now, the longer they take to acquire that gold, the more chance there is of the price going higher. Now, on the flip side of that, at the same time, they're trying to defend the peg. They're trying to defend the peg against the euro, which traders can now start to attack once again. And for every 100 Swiss francs they then print to defend the peg, they have to then buy 20 Swiss francs of gold in addition to the 1,700 tons. So if this referendum is approved and goes through, it will structurally alter the gold market significantly. Right there. And I don't think people either understand all the moving parts and how dramatic it could be, nor do they understand the chances of it going through. Now, the establishment, and I hate when people use the term financial elites because I think it's such a pejorative term, even though I understand the context in which it's being used. Let's call it the establishment, will do anything they can to stop this going through because it essentially handcuffs them and it makes them adhere to a far more honest monetary policy where they can't print Swiss francs out of thin air without some kind of backing. The only chink in the armour, I think, at the moment is the stipulation on the referendum initiative that the gold cannot be sold. That, I think, is the chink in the armour that the establishment can maybe try to persuade people is a problem, because obviously once they have that gold and they can't sell it, that if and it's a big if, the Swiss National Bank balance sheet contracts, God forbid we see a central bank with a contracting balance sheet, but obviously if that does contract, then the percentage of gold held as reserves by the Swiss will increase along with that. So potentially that's a problem, potentially. But as I said, it was less than 15 years ago that the Swiss central bank held 43% of its reserves in gold. The US holds 78%, Germany's up in the 70s, Italy's up in the 70s, Portugal's in the 80s. These central banks don't seem to have any problem holding enormous gold reserves. So I think it's spurious to excuse me. I think it's spurious to say it's a major problem for the Swiss bank, apart from shackling them from printing unlimited amounts of money.
Okay, let me now give you the other points, and then you can address them all together. Yes means no more facility for the Swiss National Bank to ensure price stability under current economic conditions, and a strengthening Swiss franc will hurt exports. Then Switzerland already has a considerable portion of gold on its balance sheet. And the last point is gold does not generate interest or dividend, meaning less profits for cantons and the government.
Well, let's address that last point first, shall we? Because traditionally that's been the number one argument against owning gold. It doesn't pay any interest, it doesn't pay any dividend, it sits there, costs you money to storage, blah blah blah. We've heard this time and time again, and now the central banks, in their infinite wisdom, have created negative interest rates in certain places and zero interest rates just about everywhere else. So that argument, it just doesn't stand up anymore. We've seen the gold forward rate go negative a lot recently, which is just indicative of the stress where people just want to own gold rather than cash it, and it makes sense. So I think the very fact that they can say that with a straight face just tells me that they assume they are talking to an audience that don't really understand the mechanics of this particular thing. On the other side of it, I think in terms of stable prices, look, the Swiss franc was backed by gold until about 20 years ago. They had a gold-backed currency. It was pretty much the last major currency to lose its gold backing. Switzerland has a history of being a strong currency. And I don't think that had ever hurt Switzerland before. The only thing that's changed, obviously, is the Swiss National Bank is now in a currency war with the ECB and with the Fed and with the Bank of England and the Bank of Japan, who all are materially trying to weaken their currency. So yes, look, could it cause problems in export prices? Yeah, of course it could. Could it impact price stability? Yeah, of course it could. But you can't tell me that the current policy of printing infinite amounts of currency doesn't have the same effect at some point in the cycle. Just because it hasn't happened yet doesn't mean it's not going to happen. So I think that at every turn, look at Japan. Japan's a good example. Look what's happening in Japan. They've got the opposite problem. They've got a massively weakening currency, which they are deliberately trying to do to stir exports. The theory being that if we can weaken the yen significantly, we can increase our exports correspondingly. Well, you look at what the yen's done, it's moved 25% against some currencies in the last year, 18 months, and exports have gone nowhere. So it doesn't necessarily, the cause and effect isn't necessarily there, because we are in this currency war where everybody is desperately trying to weaken their currencies. And if people can't weaken their currency, and I think we're reaching the point where we're going to see this with Korea and China, we'll start to see trade sanctions put in place, anything to try and protect domestic business. So, look, the Swiss Central Bank is in a bind. They've committed to a course of action that this referendum will massively inhibit them from pursuing, and they don't want to have those kind of shackles put on them. So they will essentially appeal to an audience that they presume doesn't really understand everything, and act accordingly. And I think a lot of these reasons they're coming out with are just that. They're targeted people who really don't understand. And I'm not saying there is no validity in their arguments whatsoever. There is, but I don't think it's a given that they will be disastrous for Switzerland.
One aspect of the referendum is about the repatriation of the gold reserves of Switzerland that are held in Canada and in England. As you know, there's also some problems involved related to the German gold reserves held abroad in London and in New York City. And the German Bundesbank, the central bank, says that the gold is sitting there in order to be able to react to a currency crisis, if such a crisis occurs. Can you make clear to our listeners that this is absurd, that this is a nonsense argument?
Yes, look, it is. It's absolutely absurd. I mean, the German Bundesbank do not need their gold in New York to be next to the market so they can sell it, or the same with London. I mean, you have a sovereign central bank. If they need to make a quick sale in the market, their credit's good, that they will be able to guarantee someone that the gold will be delivered. I think the problem here, again, and this is where the conspiracy theories come into play, certainly, and where a lot of people just make blanket assumptions that these things can't happen. But if you look at the flows, and if you look at particularly Alistair McLeod's recent piece that I referenced earlier, if he's right, let's say he's half right. Let's say instead of 25,000 tonnes, the Chinese have bought 12,500 tonnes over the last 30 years. That gold has to come from somewhere, and there's a lot of evidence that the gold that's sitting in the vaults in the COMEX and at the Bank of England has been rehypothecated and lent out, and there are multiple claims on the gold bars. Now, when Hugo Chavez demanded his 99 tonnes of gold back in August of 2011 from the Bank of England, I wrote at the time that was the start of a game of musical chairs, because it's fine if there are many claims on a bar. You can satisfy the first guys. It's like a Ponzi scheme. You can satisfy the first guys who come in looking for redemptions, but once you start to get either big holders or a lot of holders demanding their gold back, you have a problem. And for Germany to ask for 300 tonnes back from the Bank of from the Federal Reserve, that was a big problem. And at the time, we weren't told why, but we were told it was going to take 7 years to repatriate that gold, which again is ludicrous. There's no realistic reason why it should take 7 years if it's sitting there. And then at the end of the first year, I think they'd repatriate about 5% of the total. So there is clearly something not right in the gold warehouses. And again, it comes back to this idea that there is corruption and manipulation around money. And I suspect that the problem is one of multiple claims on a single bar of gold. And the Swiss demanding repatriation of their gold just hastens the day forward when this resolves itself either with cash settlement, which would be a disaster, or some kind of confiscatory event by someone somewhere. I don't know which way it's going to go, but I think the evidence is enough and strong enough to at least countenance the possibility that there are multiple claims on the gold bars stored in the Fed and at West Point and the other Fort Knox, etc. If that's true, if there are multiple claims on the bars, then it will be catastrophic for the gold market when it happens, and the price, there's no telling where the price could go.
Do you think it is of importance that Germany received gold bars from New York that were remelted?
Yeah, that was strange. And again, there's something about the gold market. It just begs conspiracy, and it begs people to make assumptions, and it begs people to lead to conclusions. Which is a dangerous thing to do. But as I said, it's important to entertain possibilities, and the possibilities are myriad. That there is something going on there, and I just think it's sensible for people to at least think through the ramifications of these theories being correct. To dismiss them and not think through how they could play out is a big mistake in my opinion. I think something that is important. Let's assume that it's an open secret amongst central bankers that the gold has been leased and it's not all there, and it's something they're going to work out in an orderly fashion amongst themselves over time. Well, we've seen this with central bank policy. We've seen coordination of central banks over the last 4 or 5 years, whereby they've all acted in concert and they've all done what's best for the group. In the last 6 to 9 months, we've seen a very, very different dynamic emerge, where there's a lot more every man for himself, and central banks are starting to take actions which are beggar thy neighbour policies, which are intended solely to improve the domestic situation. Now, if we see a similar sort of fracturing of the coordination and cooperation among central banks in the gold market, whereby Germany, for example, insists that we want our gold back today, and we will send our own military transport planes, and we want you to load it on there. If central banks start breaking from the herd in the gold markets and taking action that is purely in their own self-interest, then this will unwind a lot quicker, and the truth will out. And I suspect the truth will be that there are multiple claims on the bars of gold.
We are talking about gold reserves of Germany and Switzerland, and parts of it are abroad. Can you really talk about a gold reserve if you don't have all of it at your own disposal at any time under your own conditions?
Well, yeah, look, it's a great point, Lars, and again, it comes back to this cooperation thing. I mean, at the moment, there's cooperation among central banks, but let me ask you this. If you're a billionaire and you decide you're going to put $100 million of your own personal wealth in gold because you're concerned about the financial system, about social unrest, whatever it may be, but you're genuinely concerned and you want that gold as an insurance policy, what would you do with it? Would you put it in a bank vault overseas, or would you have it out of the banking system somewhere where you could get to it? Now, generally speaking, if you are concerned, you want that gold somewhere you can get to it, and somewhere you can get to it means in your own custody. Now that your own personal custody may well be overseas. You may have a non-financial institution safety deposit box in Singapore or in Hong Kong or in Sydney or wherever it may be, but once it's in that box, it's your possession. It's not in a UBS vault or a Credit Suisse vault. What the German central banks and the Swiss central bank and many other central banks around the world that store gold in the financial centres, London and New York, to be quote unquote close to the market, are doing is storing that gold in a place that at the very moment you might actually want those reserves, there's no guarantee that you'll have access to them, and that's a very foolish thing to do.
Yes. Grant, usually I don't ask this question, but I would really like to know at the end of this interview from you, what are right now the most interesting books that you can recommend to our listeners?
Oh God, how long have you got? I'm a voracious reader. I've read every book I can get my hands on. I mean, off the top of my head, ones that spring to mind that have had a big effect on me. Von Hayek's The Road to Serfdom, I think, is something that everybody should read. The Theory of Money and Credit by von Mises is another one. Adam Ferguson's account of the Weimar hyperinflation, When Money Dies, is a phenomenal book. Jesse Livermore's Reminiscences of a Stock Operator is a great read. And then sort of moving... the other one that I really love is The Extraordinary Popular Illusions and the Madness of Crowds by Charles Mackey, which is, again, it's a very, very old book, but it's a great study of human psychology. But more recently, When Genius Failed, the LTCM story is a really good read. Laws of Finance by Liquid Ahmed is a book I've read 2 or 3 times, and each time I get something new out of it. God, what else? What else? Oh, a really good book I read recently is The Great Deformation by David Stockman, which I would thoroughly recommend anybody read. I mean, there are so many great books on finance, and I think anyone that's engaged and interested in this particular part of the world will have no trouble finding some really fascinating reads.
Yeah, thank you very much for those recommendations, and thank you very much for this interview.
Lars, it was a great pleasure.
Thank you.